wouldn't want a little extra cash in their pocket? Enough to buy that new smartphone you've been eyeing, or that vacation you've been dying to take, or maybe just enough to pay for your trading commission for the next little while. That's one of the appeals of trading options, the potential to generate some added income to pad out your portfolio's returns. And one popular way traders can do so is by selling covered calls. Let's break it down. First off, a covered call involves, you guessed it, a call option. Remember, a call gives the buyer the right, but not the obligation to purchase an underlying stock at a set price. In exchange, the seller receives a premium, but along with it, an obligation to deliver those shares to the buyer if they're assigned before the contract expires. Now here's where the covered part comes in. If the call seller already owns the underlying stock, they won't be short the stock upon assignment. That means they won't have to scramble to purchase the shares on the open market to close out the position. And there's no added margin requirement to sell a covered call, so long as they hold the shares throughout the duration of the contract. So the risk is lessened, relatively speaking. Of course, this also means the option seller's profit potential is capped too. If they don't get assigned on the option, the most they can earn is the premium from selling the contract. If they do get assigned, it's the difference between the price at which they bought the stock and the price at which they're forced to sell. As for their break-even point on the covered call, it's the price of the stock when the option is written minus the premium they received. So now that you're clear on what covered calls entail, you're probably wondering, where does that extra income enter the picture? Well, let's say a trader owns a stock that they're optimistic about over the long term. They'd like to keep holding it, but they don't see its price moving much in the near term. Rather than sell it to earn some cash, the trader can write a covered call on the shares and receive a premium instead. That way, they can wait for its fortunes to hopefully pick up and earn a little income in the meantime. Now I've got your attention. Let's check out an example to walk through how this works. This scenario won't get into commissions and other fees, so make sure you're aware of them when trading. An option seller named Sarah holds 100 shares of ABC One Corp that she bought for $50 a pop. She likes the stock, but doesn't see it doing much over the next 3 months. So, she writes a covered call on her shares with a $55 strike price. She receives a $2 premium for a total of $200. That cash goes straight into her pocket no matter what happens. 3 months pass and Sarah's hunch is correct. ABC One Corp stock trades sideways and doesn't climb above the $55 strike price. The option expires worthless and Sarah gets to keep her shares, plus a tidy little profit. That's the ideal scenario for Sarah, but it doesn't always play out that way. If ABC One Corp stock climbed above the strike price to $60, the buyer would exercise the contract, and if Sarah happened to be assigned as a result, she would have to sell her 100 shares for just $55 apiece. Recall that she initially purchased them for $50 each, so that's a $5 profit multiplied by 100, which works out to $500. And when you add in that $200 premium she received, Sarah walks away with $700 total. Not bad, but she misses out on the further gains the stock made. The worst case scenario for Sarah is if ABC One Corp shares took a tumble below the $50 that she bought them for. The buyer obviously wouldn't exercise the option and she'd lose the money on her stock purchase. But at least she'd have the $200 premium to cover some of that decline. And she could always keep holding the shares in hopes of a rebound. One thing to note about covered calls is that traders typically sell options that are at the money or out of the money, meaning the underlying stock is trading around or below the strike price respectively. At the money calls can offer fatter premiums and quicker time value decay, but there's a greater chance the stock will appreciate above the strike price and the option will be exercised by the buyer. So, some traders opt for out of the money calls that can offer more breathing room but with lower premiums. Now, there's nothing to say that a trader must own a stock for a certain period before writing a covered call on it. In fact, they can write one at the same time they buy the shares using what's called a multi-leg order. Interested in how it's done? Then watch our lesson, How to Place a Multi-Leg Options Trade in WebBroker.